Hello, welcome to this video on capital gains tax focusing on rollover relief. So rollover relief is where a business might have a factory, say, and it sells that factory to move into new premises, and when it sells the factory it doesn't want to have to pay tax because the purpose of selling it was actually to buy a new factory premises, a new factory building. And that's where rollover relief comes in. It's to avoid tax when there's actually just a transition from one building into another one. Is to avoid the payment of tax there, and it rolls it over. The tax is still potentially due at a future date, but it essentially becomes dormant in the new property and then is payable later. So let's have a look at a very straightforward example. A company has a factory which it has sold. Okay, so it's sold for £200,000. So those are the proceeds of sale, £200,000. When it bought the factory, let's say 5 years ago, it cost £100,000. So there's a chargeable gain of £100,000. So that's the gain from the sale. So the proceeds are £200,000 and there's a gain of £100,000. Now, let's say there was 3 different scenarios here. The company could buy a new factory for £250,000, maybe a larger one. It could buy one for £180,000, or it could buy one for £80,000 only. So let's look at the 3 scenarios and what happens in terms of rollover relief for those 3. So there are 2 things to think about when looking at capital gains tax rollover relief. What are the proceeds of the sale and how much of the proceeds were reinvested? Any proceeds that are not reinvested have to be taken off the chargeable gain, and those can't be rolled over, and I'll explain what that means. Scenario A. Company sells the factory for £200,000, reinvests £250,000. So the full £200,000 proceeds has been reinvested, effectively rolled over together with another £50,000. So there's full rollover of the proceeds, which means that the full gain can be rolled over as well. There's no tax, no capital gains tax due. And this £100,000 gain has the effect, when it rolls over, I'm just going to do RO for rollover. When it rolls over the 100,000, there's a new base cost of this factory for tax purposes. The base cost of this factory is now 150,000, which means that in the future, if it decides to sell this factory from a tax point of view, it's going to have to quote £150,000 as being the price of the factory because it's rolled over this gain to reduce the base cost in the future. Now, let's park that and look at scenario B. So, instead of selling at 200 and buying at 250, it's now sold at 200 and it's buying at £180,000. So, automatically we can see that not all of the proceeds of sale have been reinvested, and that's crucial. Not all of the proceeds have been reinvested. £20,000 have not been reinvested. So the £20,000 that have not been reinvested, we then apply those to this. So there's a £100,000 gain that we would like to roll over, but because we haven't reinvested 20, then £20,000 of the gain has capital gains tax due and cannot be rolled over. £20,000. The amount that has not been reinvested has tax due of capital gains tax, cannot be rolled over, but the rest of it can. So we roll over 80,000 and we have a new base cost. For tax purposes, the base cost of that factory is now 100,000, which is the cost of it less the amount that we rolled over, that we were allowed to roll over, of 80. So 180 minus 80 is a new base cost of £100,000. If it goes to sell that factory in a few years' time, that's the price it'll have to say as was the base cost, and then it'll pay tax on whatever the proceeds were minus the base cost. Let's look at scenario C. So how much is not reinvested here? £200,000 were the proceeds, and the new factory cost 80,000. So the amount not reinvested, which is always the first thing to look at, the amount not reinvested, was £120,000. We received 200, we paid 80, so we did not reinvest 120. And because the 120 is greater than 100, rollover relief is not applicable. Okay, so if not reinvested, the amount not reinvested is greater than the gain, then no rollover relief, which means that the full £100,000 chargeable gain is taxable. None of it can be rolled over. And that is because the amount not reinvested, the £120,000 that we had left in our pocket by spending only 80, was larger than the gain. So if you like, we effectively didn't roll over any of the gain. If we didn't roll over any of the gain, then we can't claim capital gains tax rollover relief, and all of that gain then is liable for tax in the current year. So I hope that helps to explain rollover relief with capital gains tax. Thanks for watching.